Hey, it's Dan Morales, and this is Homebuyer Radio. This is episode number 49. This week I wanted to follow up. Last 2 weeks we kind of talked about second homes and buying a vacation home, if you will, for yourself. And this week I wanted to talk about income producing properties, meaning rental properties, right? Maybe you are thinking about starting to go down that road of buying homes and using those as an opportunity to build a portfolio of income producing properties and maybe turn it into a business. I can tell you, I've been lending since 1991, and I can tell you I have a number of clients who have done that, who have gotten into buying rental properties, and they've accumulated a significant portfolio of rental properties, and now I've got a couple clients that have kind of transitioned away from their full-time jobs to just owning properties, and that's kind of their exclusive source of income. So it can totally be done. Income producing properties, or what we in the business call a non-owner occupied property or non-owner occupied mortgage, meaning that you are not going to occupy that house as your primary residence. Those mortgages can be done. Okay, they are a little more difficult to qualify for than, let's say, if you're going to buy a primary residence. Biggest difference when you're looking at buying rental property is down payment. Okay, you're generally going to have a much larger down payment for an investment property or rental property. That's especially true if the property is one that is 2 to 4 units. Okay. So if you're going to buy something that's a 2 to 4 unit property, typically much larger down payment than if you were going to buy something that is just a single family property. Okay, so that's probably the biggest difference there. Interest rates and terms for a rental property are higher. Okay, the rates that you're going to get on a rental property are going to be higher, or the costs are going to be higher on a rental property. It's typically one or the other. They're typically going to be higher, and that's just because those loans are perceived to have greater risk. Right? That's one of the reasons why you have to have a larger down payment, and you're generally going to pay a higher interest rate, because rental properties are ones that are perceived to have greater risk. And what I mean by greater risk is, if a client experiences a financial hardship, they're less likely to pay for a rental property or a rental property that they own versus, let's say, their primary residence. And I can tell you, we saw this right in the middle of the housing downturn and housing bubble. Clients who owned a lot of rental properties. We had a number of clients where they didn't pay the mortgages on their rental properties. They took that money that they collected, the rent they collected, and they lived off of it, but didn't make the mortgage payment. They did pay the mortgage on the house they lived in, but they didn't pay the property for the property that they were renting. So that's one of the reasons why these types of mortgages can be, the terms are not as favorable, right? Bigger down payment, higher interest rate, or higher cost. The flip side, though, is they are more difficult to qualify for, meaning that a lot of times, the amount of cash reserves or money that you have to have or need to be able to have available to fall back on can also be higher as well, too. The qualifying standards for rental property can vary depending on the number of properties that you have financed. Okay, so what I mean by that is, Fannie Mae and Freddie Mac are the two biggest buyers of mortgages in the country, right? So most fixed rate mortgages are typically put into a pool of loans, if you will, that are sold to Fannie Mae and Freddie Mac, and they're typically the money behind those things. Okay, what happens is there are different guidelines between the two different investors. When you get into the point where you're owning multiple properties, meaning that you have 5 or 6, let's say, different properties that you own that have mortgages on them, those mortgages, or how you qualify for them, can start to get a little more stringent, especially the more properties you have, because the required capital or cash reserves that you need to have to fall back on can start to grow. Because what happens is, just like any other lender, when you have 6 or 7 loans out to a particular client, your risk starts to go up, and you want to make sure that this person has some wherewithal or ability to weather the storm if there's a downturn in rents or something like that. So again, they are much more complex transactions to qualify for. And let me tell you, if you're thinking about buying a rental property, you need to work with somebody who knows what they're doing. Okay, I can't tell you how many times I have had clients turn down for a rental property loan, and we've been able to make take that mortgage. And it has to do with the fact that if the mortgage lender that you're working with is not experienced and not competent with these types of loans, they oftentimes will qualify you incorrectly and then tell you that you aren't qualified or you don't qualify for the mortgage when in fact you could have. I've had this so many times it's not even funny. So if you're thinking about buying a rental property and you're looking for a mortgage, we'd love to be the folks that help you out with that. Again, I lend in pretty much the majority of the 50 states and would love to be able to help you out if you're looking for a rental property and looking to get something financed. Again, my name is Dan Morales. My NMLS number is 709729. You can reach me at 616-931-4629. Again, 616-931-4629. Dan@danmorales.com is my email address. And website is just danmorales.com. Again, North Point Bank is an equal housing lender.